Good evening, ladies and gentlemen. This is Tommy Duncan, the third, otherwise known as TD3. It is Wednesday, August the 13th, 2025. And if it is Wednesday night, it is Black Men Speak. Back again, I want to thank you, ladies, for joining us this evening. We have a content rich episode tonight and looking forward to having one of our favorite and special guests back for a follow-on episode, ladies. So get ready. If you've not done so already, make sure that you like this episode. Make sure that you share this information with someone that you believe will get value from it. And of course, subscribe if you have not already done so. So with that being said, we are going to join back this evening from just a few weeks ago, our good friend, my fellow Aggie, my fellow Alpha brother and CPA extraordinaire, John Williams, who is going to go through part two of what we discussed a few weeks ago about the 2025 U.S. tax and spending bill and talk about who we think won, lost, but most importantly, how do we take advantage of what's happening politically and economically in this country. So let's go ahead and get the show started. But before that, we do have a couple of stories that we do want to make sure that we share and highlight before we get started with the meat and potatoes for this week's show. For those of you who may not have heard, a couple of days ago, former television star and one of my favorites when I was young, Danielle Spencer, who portrayed the Dee Thomas in the 1970s comedy sitcom What's Happening, has sadly become an ancestor at the young age of 60. She was affectionately known for agitating her big brother Roger, played by Ernest Lee Thomas, often saying, "I'm gonna tell mama," in What's Happening. You might know this beautiful face in her then and more recent pictures of now. In an Instagram post, fellow star and friend Haywood Nelson, who played the character Dwayne, often known for saying, "Hey, hey, hey," said Spencer passed Monday in Virginia. A family spokesperson indicated that Spencer had transitioned after a years-long fight with cancer. Born in New Jersey, she, interestingly enough, had a serious injury in a major car crash that could have been catastrophic in 1976 that killed her stepfather, actor Tim Pelt. She attended the University of California, Davis, pursued a degree in medicine, thereafter attending Tuskegee University Veterinarian School in Alabama to pursue her lifelong passion for helping animals and becoming a veterinarian starting in 1996. So it is with humility that we, of course, offer our condolences to the family, the What's Happening family, those who knew her, those who loved her, and those who supported her. And again, she was one of my all-time favorites when I was a kid growing up, and TV was really saying something and really teaching something. So our condolences, and we will definitely see you on the other side. Another interesting story for those of you who may follow sports and tennis in particular. Last week, Victoria Mboko won her first major women's tournament championship at the National Bank Open in Canada. She entered the tournament as a wild card and defeated a series of top players and Grand Slam winners, including Coco Gauff and the number one seeded Naomi Osaka. Mboka joins a select group of Canadian players to win the National Bank Open. The win has propelled her to a career high ranking of number 25 in the world. And this is a new face. You know, someone you probably are not familiar with, but you definitely need to keep your eyes out for. The victory has given Mboka a significant confident boost as she prepares for, of course, the upcoming U.S. Open. Mboka, who is Congolese and represents Canada, is the second youngest player ever to achieve the feat of defeating 4 Grand Slam champions in one tournament. So we would like, of course, to congratulate Victoria and Boca. We will definitely keep our eyes out for you, and we wish you the best of luck. And one follow up story from last week that we did report here on Black Men Speak regarding Sha'Carri Richardson. Interesting note that we just found out. The Olympic sprinter and gold medalist addressed her recent domestic violence arrest in a video on social media and issued a heartfelt apology to her boyfriend, also track star Christian Coleman. Richardson posted a video on her Instagram account this past week stating that she put herself in a compromised situation, issuing a written apology to Coleman stating she loves him and can't apologize enough for her behavior. And therefore, her apology should be just as loud as her actions were in the media. Richardson was arrested, for those of you who may not know, on July 27th on a fourth-degree domestic violence offense for allegedly assaulting Coleman at Seattle International Airport. The arrest was days before she ran the 100 meters at the U.S. Championships in Eugene, Oregon. According to the police report, an officer reported was notifying TSA of a disturbance between Richardson and Coleman. The officer reviewed camera footage and observed Richardson reaching out with her left arm and grab Coleman's backpack, yanking it away, then appearing to get in Coleman's way. With Coleman trying to step out of her way, Coleman was then shoved to the wall. I don't want to go on for this, but we did talk about this last week. And again, as we discussed, when you are famous, regardless of your wealth, when you are famous and you have people who are funding you, when you have people who are representing you, you have to carry yourself in a certain way. And Sha'Carri Richardson is one of, the broader brands in the world, especially in Olympic sports. She won the 100 at the 2023 World Championships in Budapest and finished with a silver in the Paris Games in the Olympics last summer. She didn't compete during the Tokyo Olympics in 2021 following a positive marijuana test at the U.S. Olympic trials. She's currently 25 years old. So we certainly hope that she's able to learn from this, take something away from this, positive, and understand that with much fame comes great responsibility. But more important than that, you have backers. And there are several reasons why she needed to make this very public and do right by this. A couple of those reasons: Nike, a 4-year, $20 million contract. Sprite, the first one to ever sign a female athlete. Dannon and Google, household names. So, you're not the person that you were before when you become a worldwide star, or when you have international multi-billion-dollar brands who are representing you. And so this is hopefully something that you can take away, do something positive from it, and be a positive influence to young ladies who are following her all over the world. Because regardless of whether you want to be or not, when you are in that position, you are a role model. So with that being said, we wish her the best of luck. And of course, we will definitely be keeping an eye on that. So those are our short stories today. Before we get started with our main story, I'd like to introduce and bring back my good friend that I have known for many, many years. I won't age him or myself, but welcome back, John. We appreciate you joining us again. How's everything been going, my good brother?
Oh, it's going good. Thanks for having me back on the show, Tommy. It's
Yeah,
always good to see you. Yeah,
absolutely.
like I've said in the past, it seems like it was just yesterday on a cold December night when we walked across the stage at Texas A&M, but that's been decades ago now.
A couple of years,
Yeah.
but that's okay. I won't say how many decades, but it's been a little while. But, we have had folks, for those of you who are joining the show for the first time, we've definitely had John on our show to talk about tax, finances, and a lot of other areas. Want to acknowledge our cousin Audrey K, who is on the chat line. For those of you who are out there, jump on the chat line because we'd like to hear from you if you have any questions, thoughts, or observations, because we are going to be talking or continuing our conversation about the impact of the 2025 U.S. tax and spending law, because it is now law. It has been passed, and it is now the law of the land. We talked about this a few weeks ago, but we just kind of scratched the surface and felt that it was appropriate that we continue that conversation and localize it as well, to discuss how it impacts you and me, the average everyday worker and or entrepreneur business person out there, and then kind of dig in to, who we think really won, who really lost, and how do we take advantage of what's going to be impacting us within the next few years. So thanks again for coming back, John, and let's kind of start the show. For those of us who may not have been here the last show, we can kind of give a brief summary, unpack,
Okay.
what the major components were of the U.S. tax and spending law, and then we can get down to business. So I'm going to yield the floor to you, my good brother.
Okay, great. Once again, thanks for having me again, Tommy. Well, just to do a quick recap of our discussion from a couple of weeks ago, um, the spending bill, the tax bill was passed on July the 4th. So we're a little bit over a month, into the game. And with changes of this magnitude, it's going to take the IRS time to actually digest the legislation and start to reprogram their computers and issue guidance, or put out publications that gives guidance to a lot of these new tax laws. So we're still early in the game. But as I mentioned last time on the show, the I would say the biggest one of the biggest takeaways from the big beautiful bill, or however you want to term it, is that it is essentially a continuation of the Tax Cuts and Jobs Act that was passed towards the end of 2017. And so that was the tax legislation that was passed during the first Trump administration. So a lot of the provisions of the Tax Cuts and Jobs Act were set to what we call in the tax world, they were set to sunset, meaning that the law would just the law would go away at the end of 2000, for the most part, at the end of 2025, and then we would revert back to the tax rules and regulations that were in place prior to the passage of the 2017 Tax Cuts and Jobs Act. So for a comprehensive, I guess, detail of what the new bill covers, that would be a good place to start, just in case you need some material to help you fall asleep, at night before you go to bed. You could go back and pull that legislation and take a look at it, and that'll be a good starting point.
And I think, John, that's probably one of the biggest things was basically making permanent the um, the tax structure permanent. And that was probably, the biggest win for a lot of folks, especially in certain tax brackets. But do you think or presuppose that this would have had an impact one way or another if it didn't happen? The only way it wasn't going to happen is, of course, for the current administration to not be in place. But what impact do you think it may have had on the economy,
Yeah.
one way or the other, given the tax code?
Well, revisiting back to my comments from the show, I mentioned that one of the, I guess, ways that the legislation touches pretty much all Americans is the fact that it keeps in place lower tax rates. And so, just to run through these real quick. So before 2018, so before the 2017 Tax Cuts and Jobs Act was passed, our tax rates were 10, 15, 25, 28, 33, 35, and 39.6. The passage of the TCJA brought in tax rates of 10, 12, 22, 24, 32, 35, and the maximum tax rate of 37. So to kind of answer your question, the individuals at the lowest end of the tax code or tax, spectrum, however you want to look at it, in particular in the 10 and 15% prior rates and then the 10 and 12% current rates, they were really not impacted by the tax rates that much at all. I mean, yeah, there is a difference between 12 and 15%, but if you look at the income that was included in those brackets, there was very little benefit from, even if this law would have gone away, if the tax rates had have gone back to what they were in 2017, it wouldn't have really mattered. As you move up the ladder, when you get more to the 24, 32% tax rates, it starts to make slightly more of an impact, not simply because of the rates themselves, but some of the other adjustments that roll into that roll into the calculation of taxable income. One of the biggest ones being the standard deduction. But once you get above the 33, or once you get to the 35% tax rate and up, so under the old law, it's 35 and then 39.6. Under our current tax structure, it's 35 and then 37. Once you get to those rates, those are the individuals that are going to benefit the most by by maintaining tax rates where they are. Because I mean, let's say if you have $1 million of taxable income, would you rather the top tier of that $1 million of income be taxed at 39.6% or 37%? So as you move up the tax ladder in terms of the tax rates, taxpayers will benefit more from the new tax legislation.
Gotcha. So the more money you make, the better off you are.
Yeah. So to a certain extent, most of us will benefit. I'll benefit personally by the tax rates that are now law, but obviously the people at the lower end, in terms of taxes, they're not going to see a big difference. Now, I don't want to jump too far ahead of myself, but one of the points that I wanted to make when I was thinking about the show tonight is when we look at the, tax legislation, one big beautiful bill, however you want to term it, you have to look at it really in kind of two buckets. At least I do. So you say, well, the legislation affects people differently from a tax standpoint as opposed to maybe an indirect financial or socio-economic aspect. And what does that mean? and so what I mean by that is that a few minutes ago, I just said that the people at the lower end of the spectrum didn't really see that much of a difference. Well, maybe not from a tax standpoint, but if those people at the lower end of the tax bracket or, for example, are on the Affordable Care Act, or recipients of Medicare, that could be
Medicaid.
a significant difference in their,
Talk.
not necessarily in their tax bill, but in their, just their overall financial health. And
Okay,
so let me
talk
just,
talk a
let
little
me
bit.
throw out,
Talk if you could simplify and talk about what that looks like, because I'm sure some of our viewers either may be in that bucket or they may know
oh
someone
yeah,
in.
I'm sure they are. I
Right.
mean, I would think that, um,
How does this impact them for
well,
those who?
let me throw out some numbers,
Okay.
Tommy, that, that may help a little bit. And these are numbers that I pull from the Congressional Budget Office and Joint Committee on Taxation, and it's supposed to be a bipartisan committee. So hopefully, you know, it's pretty much. I would think it's pretty much down the middle. So 71 million individuals are currently enrolled in Medicaid, including children, older adults, people with disabilities. Another 24 million are enrolled in the marketplace, or affordable care, or Obamacare, how you want to call it. And that affects individuals. It also affects individuals who are running small businesses. So what the one of the provisions of the new tax bill is, it does, I mean, it does a lot of things, but just from 1,000 feet, uh, it makes it a little bit tougher. Well, it makes it tougher for some individuals to qualify for Medicaid. And so, going back to my comment about taxpayers that are at the lower end of the spectrum, so the way the Affordable Care Act works is, you have to be, in order to qualify for the federal credit. So basically, if you sign up for the Affordable Care Act and your income is 100% of the poverty level up
Mhm.
to 400% of the poverty level,
Right.
you can qualify for a credit. So if you sign up for the insurance, and let's say that I'm just pulling a number out of the sky. Let's say that your premium is $600 a month, and you qualify for a credit of, from the marketplace, of $100. So each month you pay a premium of $500, and the rest is paid, by the government. And so as your income goes up, as you approach the 400% of poverty level, the credit eventually goes away. So
What is poverty level annual income? It doesn't have to be exact.
uh, I can look it up. I don't have it
Okay,
right in
don't worry
front of
about
me,
it.
but
Okay,
I know it, and it's adjusted a little bit for inflation every
okay,
year.
gotcha.
But so, um, in 2021, the uh, the American Rescue Plan Act, which at the time President Biden was the president, it expanded the role of the federal government in terms of how, who would qualify for the Affordable Care Act. And so what's going to happen with the new plan is the federal government is going to make it a little bit more rigorous for individuals to qualify for the program, or I should say, the federal government is going to re- put more of the responsibilities on, especially in terms of Medicaid and in terms of the ACA credit. Um, a lot of the expansion of the credit under the 2021 American Rescue Act is essentially going to be pulled away. So my point is,
Okay, so if I could stop you right there, we're in the state of Texas.
yeah,
And so, in essence, what you're saying is for a lot of these healthcare benefits, the federal government is going to say, okay, states, you start paying for this. And this is something that they haven't been paying for in the past, right?
that's correct.
So the
And
question then becomes
just
for
but
some,
to throw something out, Texas won't be as heavily impacted as other states because Texas, we didn't go gung ho from the beginning to
it's political.
yeah, yeah,
It's
yeah.
political.
So in the states, I want to say, like, off the top of my head, I want to say one of them is North Carolina. States that were a little bit more generous or a little bit more aggressive in terms of what they were willing to, the programs that they were willing to put in place for Medicare, Medicaid. Those individuals who live in those states will be more adversely affected as when compared to states like
So
Texas.
benefit, so maybe with the exception, I want to say Texas may be an exception, but when you have red states that are poorer, let's say Arkansas, Alabama, um, states that probably have a poor net income average per person by population, most of those states did not take advantage of ACA, even though a lot of their citizens probably could have benefited from it more. So, what happens with a state like Texas, or with a state that doesn't have a high income population, and they said, "Well, no, we're not doing this." Do those folks just lose their health care? Because you're
Okay.
talking about 20, you mentioned 70 million, so that's like 20% of the US population. 70.
Yeah, yeah. So the way the program works, and obviously I'm not an expert on ACA or Medicaid, but so a second ago I mentioned that if you're at 100% of poverty level, you qualify for the Affordable Care Act. If you're below that, that means that you would have to go through Medicare. So if you're not at 100% of poverty level, you don't qualify for ACA. That's one of the questions that I think they ask you when you log on early on in the program. And so if your income is not at that level, then you're covered by Medicaid. And so that's where the new some of the nuances of the new plan come in. And I want to say there is a requirement to where Medicaid recipients need to work
Yes,
it's
exactly.
80 hours a
Correct.
month.
Correct. Correct.
And there are exemptions to that. And so just some of the exemptions are parents, guardians, and caregivers, especially those with children younger than 14. I mean, there's a whole list of individuals participating in substance abuse treatment. Um, there's just a ton of, well, I wouldn't say a ton. There's probably 7 or 8 uh, individuals with intellectual or development disabilities, mental health conditions, or disabling conditions. So there are some workarounds to having to work the 80 hours a month. But a lot of that literature and interpretation is still being worked on by the IRS because you have to realize they've only, the tax legislation doesn't come from the IRS. It's formulated in Congress, and then they dump it onto the IRS
And then they got to figure it out.
and let them figure it out. And
All right. Good deal.
I'm not. I guess I'm normally punching the IRS in the stomach, but I'm trying to give them a little benefit. They
Got
have
it.
a,
Well,
they have a lot to deal with.
for those who are left, because that's one of the departments that got kind of gutted too, right? The IRS.
Oh yeah, yeah.
So
So
they got gutted too along with the Department of
uh,
Education.
uh,
There is a question though, John, that I want to make sure that I don't forget to get to. We have one of our folks on the chat line, Miss Marion, says, "Is it correct that overtime and tips, which this was another big thing, is it correct that overtime and tips are only at regular wages? Meaning, if I work overtime, only my regular pay wage rate is non-taxed. Does that?" And I'll
well,
keep the question. Is it correct that are overtime and tips only at regular wage? Meaning if I work OT only, my regular pay wage rate is non-taxed.
well, let me answer it this way, and then maybe the listener can, if this doesn't
Ask for
answer that question.
clarification. Okay.
So the uh, the tips are not taxed up to $25,000.
Okay.
So the tips will still appear on the W-2 when the listener, he or she, receives their W-2 in January or February or whenever. The tips will still be listed on the W-2, but once they hand that uh, W-2 over to their tax preparer, or if they're preparing it for themselves, the software will adjust out tips that are, less than 25,000. Does that make any sense, Tommy?
I don't know. So if I recall, and I know we talked about this on the last show, I know that tips are tips were exempted from taxes up to a certain amount,
Up
correct?
to twenty-five thousand
Up to
dollars.
25,000. Now, if your tips exceed 25,000, there,
Yeah, yeah. So if they exceed 25,000, if they're 26,000, that means that $1,000 gets taxed. It's added into, just like your taxable income, just like like it always has been.
okay. And how does that apply, if any, to, because she's also speaking to overtime?
Well, for overtime, you can deduct up to 12,500 of overtime if you're single, and 25,000 as a joint filer.
Okay.
So it will work the same way. If you receive 12,500 of overtime and you're single, you don't pay tax on
Okay.
that. If you get to 13,000, that means that the other 500 would be taxable. And once again, all of the numbers are going to show up on the W-2, but there'll be, well, I'm assuming that I hadn't seen the new W-2. The IRS doesn't have it out yet. But at the end of the day, however the W-2 looks, the tax return the tax software will adjust out the overtime up to that point. Now, not to get too deep in the weeds, but there are exclusions. Once you get to certain income levels, that those benefits go away. So I would think that someone who's probably working, well, I wouldn't necessarily, I guess I shouldn't necessarily say that, but more than likely someone who's working in the industry that's earning tip income, they're not going to approach. If you're single and you make over $150,000, that deduction goes away, and it's 300,000 if you're filing jointly. So I would think this is geared mostly to probably individuals who sometimes may have a couple of jobs, in this industry. They may work half a day as a waiter or waitress at is this establishment and somewhere else at another establishment, or they could be part-time students. So I would think for the most part, people who qualify for this exemption, I would think that to be uh, they're not going to be phased out of the income. the income restrictions.
Gotcha. All right. So just to kind of summarize, we talked about this a little bit earlier. As far as the tax code is concerned, for those of who are low income, they're really not impacted that much. I mean, in general, there's going to be no change to the tax code because it's not going away. It's becoming permanent. So for
Yeah.
those, go
Well,
ahead.
there are some slight changes. I mentioned that obviously the standard deduction is going up. The
Correct.
standard deduction for singles this year will be 15,750.
Compared to what last year?
I'd have to look up. I want to say more closer to
I think it
like
was a 14
right under
last year.
14, I believe.
So about a 1,000 in additional in deductions. A
Yeah,
thousand dollars,
and
give or take.
then for joint filers, it's 31,500. Then head of household, 23,625. So from that respect, the majority of Americans use the standard deduction as opposed to um, itemized deduction. So itemized deductions being mostly mortgage interest, property taxes, charitable donations. So given the fact that the majority of Americans use the standard deduction, by default, they will benefit from a higher deduction rate, assuming that they have enough taxable income for the standard deduction to impact.
So for folks who are out there and you have a home that you're on the early end or front end of your mortgage, uh, then there are some consequences there because, of course, you're paying a lot of interest. And if you live in a high income neighborhood, you're paying a lot more in property taxes. It may or may not affect you in some way, right?
Yeah, yeah. So, under the prior law, we talked about this on the last show, there was a cap of $10,000 on state and local tax that taxpayers could write off every year. That number has now been increased to 40,000. So that's a big win. It's a big win for a lot of Texans.
Repeat that again, John, just so we can make sure that they got that. Repeat that again to make sure everybody got that.
The Tax Cuts and Jobs Act when it was originally passed, it put into place a $10,000 cap on state and local taxes every year in terms of the amount that you could write off. So the acronym is called a SALT tax.
Right.
And so it stands for state and local taxes. So basically in state income tax, we don't have one in Texas, but
Correct.
obviously, other states do. We do have a sales tax. For most of my clients, I don't ask them to sit down and give me a total of all the sales tax that they pay during the year, unless there are some big items. So for Texans, the way that works, there is a tax table in the IRS software where it looks at your adjusted gross income and it just pulls off it assigns a number for the state and local tax, and that gets added in. But you didn't ask me all of that. So and then obviously the other two big ones are going to be your mortgage interest and the big mortgage, the big itemized deductions are your mortgage interest, state and local taxes, and charity. So under the old law, there was a maximum of $10,000 that taxpayers could write off for those SALT taxes. And so that means, like, if your property taxes in Texas was 12,000 in 2024, the most that you could write off is 10,000, and the other 2,000 went into a black hole, which is not good. It didn't roll forward. So it's not like you lose, you deduct 10,000 and the $2,000 that you were not able to deduct in 2024, it doesn't roll into the future. It goes away. And so now let's assume that if you live in New York or California or states that have maybe they may not have as high as property tax as Texas, but they have a state income tax, so they could easily, and a husband and a wife making 250,000, I mean, they could, with all in with state and local taxes, they would easily go over the $10,000. So, especially if you're in, probably California or New York. So that is a big win for taxpayers that itemize. If you don't itemize and you take the standard deduction, it doesn't impact your tax return at all.
So let's kind of break this down into do a couple of different brackets. Low to moderate income, working poor, middle class. There are a couple of tiers to that, and then those who are wealthy. And I don't know what wealthy is. I want to say maybe 250 to 300 grand a year and above. But that's income, not net worth. So if we talk about who are the biggest winners and losers, or let's say biggest winners and losers, let's say who gained the most, who lost the most, at the lower income bracket, middle class income bracket, and or the wealthy. What would your abbreviated breakdown of that look like and why?
Well, reverting back to my earlier comments, from a tax standpoint, for the most part, if you're just looking at income taxes, most of us, we won to a certain degree, except individuals at the lowest end of the tax spectrum.
Okay.
But on the other hand, those are the individuals that more than likely are going to qualify for ACA, uh, uh, reduced ACA insurance via the uh, premium, the premium credit. And if they don't qualify, if they don't have enough income to qualify for ACA, they may be impacted, or almost 100% sure will be impacted, because they will fall in the category that they will be covered by Medicaid.
And from my understanding, John, there's going to be a hit to folks in Medicaid, CAID, not care, but Medicaid, and then folks who are using SNAP benefits, what we used to call food
Yeah, yeah,
vouchers. And
yeah.
so,
So the SNAP benefits, in order to maintain the same benefit level, the states need to will need to chip in more. The federal government, I don't have the exact percentages, but the federal government under the new tax act will not give the states the same amount of funding that they have in the past. And
and
a lot of the extended funding occurred, like I said, during President Biden's, I guess that would be his second term during, 2021. So, I think you were asking me more about taxes. So
right.
one thing that we didn't talk about, and this, I don't know, that's almost a whole different show, but obviously if you own a business, you're asking me who benefited and the
Who
most.
wins, who loses by
Yeah.
who wins, who loses by
So,
category and why?
so I would say if you own a business, um, you
And Trump is pro-business.
yeah, I mean, and not, it doesn't just have to be a big business, to be honest. If you have a business, especially, for example, if you own what's called a pass-through business, in other words, if you own an LLC, an S corp, and even a sole proprietorship where you're operating as a Schedule C, uh, one of the one of the to me, one of the biggest pieces of legislation that was passed, or the most significant pieces of the Tax Cuts and Jobs Act, was the Section 199A deduction for qualified business income. And I know I don't want to get, that's a whole lot of tax,
So what does that
but
mean in
but
layman's
to,
terms?
but to make that in layman's terms,
Yes.
starting in 2018, if you operated one of these entities, a pass-through entity, and you had, to make it simple, if you have net income or business income, um, from, whether, no matter if it's S corp, Schedule C or LLC, if you had qualified business income, essentially net income from that business, you received a 20% tax deduction. So let's say, that's really big.
So wait.
And so,
Okay, if you get when you clarify qualified business income, and then when you say 20% tax deduction.
well, let's for example's sake, let's just say let's just say your income from the business. So let's say that, um, what's a good business example? Um, I mean, let's say that you are a auto mechanic and you own a mechanic shop with another uh, individual, and so let's say that after you take all your income and all your expenses, you end up with $100,000. And let's say if you own it 50-50, so $50,000 goes to one LLC member and 50,000 goes to the other. So on that individual's tax return, um, they would get a 20% tax deduction. And that was, ironically, that's something that even the Trump administration, when they were when they were, I guess, prepping taxpayers or prepping Americans for the passage of or the continuation of the Tax Cuts and Jobs Act, it didn't really get talked about a lot. What a lot of if you get on the YouTube or you listen to podcasts, one of the first items that most individuals, most tax professionals talk about is bonus depreciation, which is good. Yeah, it's good to have uh, bonus depreciation, essentially where you can write off an entire asset in the first year of purchases in certain circumstances. I don't mean to downplay that, but you have to remember with depreciation, whether it's bonus depreciation or regular depreciation, you will eventually get to take that deduction. Whereas the uh, QBI, the qualified business uh, income deduction, that was like, in some ways, if you own a business, it's kind of like manna from heaven. But no one really talked about it
So
a
are you
lot.
saying
So
that if I own a business and let's say with the new tax code, my
it wasn't not just now. It started in 2018, so it was part of the Tax Cuts and
okay,
Jobs
in
Act.
that case, starting in
Yeah.
2018, if my tax rate was 37%, now it drops to 17%. Is that what you're saying?
No, no. Uh, so I'm saying that if you own a business and you have income from that business, to just there's a long definition of qualified business income, but let's say for tonight's example, you have income and then you have all your
Correct.
normal business
Correct.
expenses, and then that nets out to qualified business income. There's other
Fair
ins and
enough.
outs
We won't go
but
into
for
it.
the most part, that's how you get
Okay.
to the number. So essentially, you would get to take a 20% deduction on that income before it flows through to the rest of your tax return.
So what you're saying
So
is, if I have $100,000, for lack of a better term, in revenue, and I have $50,000 in expenses, then my qualified business income is $50,000.
it's
But I'm getting a
50,000.
20% discount off of that 50,000.
Yeah, so it's not a 20%
Okay.
credit, it's a 20% deduction. So the way it would work in simplified terms, you would basically get a $10,000 deduction, and that gets deducted from all your other income. You could have interest income. You might have income from a lot of different sources, and then that number gets backed out of your it gets taken away before you arrive at your
So
taxable
again,
income.
$100,000. I made $100,000 in revenue, $50,000 expenses, qualified business income of 50 after I take out the expenses, and then I cut an additional
Yes.
$10,000 out of that 50 that's left. And
Yes.
so now I'm taxed on $40,000 as opposed to $50,000.
Essentially. But like there again, that's
Just
making
keeping
the
it simple, but
example. That's keeping it very simple because I mean, in that if you operate a small business, you have to also realize there's self-employment tax, and that's calculated on a whole different part of the tax return. So, but in terms of just the section 199A deduction, that's essentially how it works. That's how you arrive at qualified business income, and you take that number times 20%. So that is really big for anyone who operates a business, who's operated a business from 2018 forward. Now, if you lose if you lose money at the business, that doesn't have any
okay.
impact.
Fair
That
enough.
that calculation is only
Okay.
applied
Let's
to
we
positive
got 9 minutes
income.
left. So let's talk about while we've got a little time left, and if there's anyone out there in the chat line and you want to ask a question, what's going on, cousin Lisa? Hey, hey, that's my attorney cousin. If you have any questions as far as taxes are concerned, this ain't free time, Elisa, but you can ask some questions regarding the new tax and spending bill for the low income, middle class, and high. What would you say are the biggest wins? And then for each of those, what are the biggest misses for each of those groups? What's the biggest win and what's the biggest loss for low income, middle class, and high income? And then for folks who are, let's say, business owners, while we got a little time left.
Uh, well, for I would say for individuals at the lowest end, if for some strange reason you're not impacted by the Affordable Care Act provisions or Medicaid, there's almost no change from a tax
Okay,
standpoint,
gotcha.
or very little change.
But
When you get to the middle tax brackets, like we said, that those numbers can be impacted significantly depending on if you live in a state that has a state income tax, if you have a property that has high property taxes. Uh, so it's you really can't make a blanket
gotcha.
statement, across the board. But it depends on which bucket you fall into. But I can safely say that if you are at the upper end, you're going to
A whole lot.
benefit. You're going to benefit a lot more than individuals at the lower end of the spectrum, simply by if you just look at just the tax rates themselves. And then you also have to realize that there are probably a lot of the individuals that are in the higher tax brackets. They more than likely own businesses, like the example I just gave you in terms of the Section 198, 20%
Okay.
qualified business income deduction. So they're probably going to be able to take advantage deductions similar to those, as opposed to individuals at the lower end of the spectrum. Obviously, if your income is primarily from tip income, that's going to, that could be a very significant
A game
pickup for
changer.
someone at the lower income. So I don't totally want to just fluff over that, because
A
that
game
could,
changer.
obviously that would be big if you're I mean, if your total income is 25,000, if all your income is 25,000,
You're tax free.
and that means that 12.5 of the income is no longer taxed. So uh, that's that. I think that's probably going to be a unique situation. probably something that applies more to or individuals that are part-time, employees in the
Gotcha.
wait staff.
There's one question I want to make sure that I get to. Cousin Audrey K asked, and this was regarding our prior conversation. So, in essence, are you saying a small business can deduct 20% of their net income for qualified businesses?
Yes, yes,
Yeah,
that law has been in place since
since 2018.
2018.
Okay, so cousin Audrey, K, let me know if that answers or clarifies your question. So, folks who make a lot of money and folks who are business owners,
Yes.
they did really well
Yeah,
with this
yeah,
law.
yeah. So, I mean, also, we kind of touched on uh, also on businesses that are business owners who buy equipment. Obviously, they're going to benefit substantially by having 100% bonus depreciation placed back into place. Like I said, depreciation, if you own the business long enough, you'll be able to write it off anyway. But as Tommy, what they taught us at A&M, a dollar today was worth more than a dollar tomorrow. So
Yeah.
essentially, by taking the depreciation on front end, that gives you pay less taxes, so that gives you more money to grow the business or do whatever else you want to with it, except send it to Uncle Sam.
All right. Now, all of this is going to cost, and I believe the CBO Congressional Budget Office has indicated at a minimum that this is going to cost us, what is it, somewhere in the range of $3 trillion over the
Yeah.
next 10 years.
Yeah.
With all this great stuff that people are hollering about, how does this impact us long term if, in fact, it's $3 trillion at a minimum over the next 10 years?
Well,
You got to pay for this.
so that's where you kind of have the tug of war come in between Fed chairman and the Trump administration. Is that uh, Chairman Powell? He is very hesitant to lower interest rates because of two reasons. Lower interest rates stimulate spending,
Yes.
which increases inflation.
Correct.
So the tariffs, by nature, will increase inflation because we're going to eventually
Everything costs more.
now. You're going to eventually pay more for the product, whether it's computer chips or car or watches from Switzerland or wherever. So you're going to pay that contributes to inflation, but also the fact that the federal deficit is increasing. That
So
will
what you're saying is we already have tariffs, and if we lower the
we
interest,
already had a deficit before tariffs. Now we have
right,
tariffs.
right, and now we've got tariffs, and if you add interest rate decreases, which stimulates spending, which increases inflation, then you've got hyperinflation.
Yeah. So to me, if you're lobbying for lower interest rates, something has to give. You can't continue to expand the federal deficit and charge tariffs, which at the end of the day, the businesses are absorbing some of the tariffs, depending on what industry is in. But at the end of the day, businesses they're not going to
pass that cost to the customer.
They're not biting all of it, by the way. They're not going to bite the bullet indefinitely. And sooner or later, me, you, Joe Blow, consumer is going to have to
We're going to have to eat the cost.
Pay for higher products. Now, I mean, I guess there is some analysis that needs to be done, in terms of, okay, long term, will it eventually coerce these other nations to be better trade partners? That's what the thinking is. And so, I'm not Henry Kissinger, so I can't really tell you how it's going to affect all these countries right now. It's too early in the game, but that's the tug of war that we see now in the news. Is that especially in this meeting coming up in September, there's a lot of pressure, not only from President Trump, but there's pressure from other members of the Federal Reserve Board to lower interest rates. And just my opinion, I feel like up to this point, Chairman Powell has done a pretty good job.
Gotcha. And with that, folks, we are out of time. It is the top of the hour. John, I want to thank you again for joining us. I want to thank you for sharing more insight in terms of who win, who's losing, and how do we take advantage of the 2025 U.S. tax and spending law. We, of course, will have you back in the future, John, and we appreciate you, my brother.
Thanks for having me.
And folks, I hope you've learned something from this. And of course, if you want to get in contact with John, you have any questions regarding taxes, or you're looking for someone that can up your game, there we go.
Give my regards to Jimmy.
All right, and we want to thank everyone again. Everyone have a good evening,
Take
and we
care.
will see you next week.